Your best trading month is your biggest risk. That sounds backwards, so let me show you the math before you decide I'm wrong. Most people think a winning streak means they finally figured it out, that the strategy clicked, the edge is real, and the hard part is behind them. That is almost never what a winning streak means, and in the next few minutes I'm going to show you exactly what happens inside your account and inside your head right after your best month, and why that moment, not a bad month, is when most traders give everything back. Let's use real numbers because round numbers make this too easy to dismiss as something that wouldn't happen to you. You start the year with a $10,000 account. You're selling cash secured puts on dividend aristocrats, boring companies, PepsiCo, Johnson & Johnson, Coca-Cola, one contract per position, defined risk. You take the small loss when you're wrong. No arguments with yourself about that. Month 1, you sell a PepsiCo put, strike at 165 and collect $210 in premium. It expires worthless. You do it again on Johnson & Johnson, strike 155, collect $190. Small, boring, exactly like it's supposed to be. Total for the month, plus $400. Month 2, you widen out slightly, still one contract at a time. Coca-Cola, a roll on the PepsiCo position. A fresh Johnson & Johnson put after a dividend bump pushed the stock up, plus $350. Month 3, the market gives you a small pullback, which is actually the best environment for this strategy because premiums get fatter when there's a little fear priced in, plus $600. Add it up and you're up almost 14% in a quarter on boring stocks using a strategy that's supposed to be conservative. It feels earned because in a narrow sense it was. You did the work, you picked reasonable strikes, you managed risk the way you were supposed to. Here's the part almost nobody explains clearly. That win streak just changed how your brain evaluates every decision you make from here forward, and it did it without asking your permission. It shows up in 3 predictable ways, and I want to walk through each one with a real trade, not a vague warning. First, position size creeps up. The one contract rule quietly becomes 2 contracts because 2 has been working. You don't sit down and decide to double your risk. It happens more like this. You're looking at a 4th PepsiCo put, same setup that's worked 3 times already, and the thought that crosses your mind isn't, should I take more risk? It's, why would I only do 1 when this keeps working? 2 contracts at that same 165 strike, same premium per contract, and your max loss on that single trade just doubled without a single new thought about risk tolerance. Nobody reran the math. The math just got twice as dangerous while you were busy feeling good. Second, the rules start bending, specifically around the situation you used to avoid on principle. Say you've always skipped selling puts into a company's earnings announcement because a beat or a miss can gap the stock 10 or 15% overnight, blowing straight through your strike with no warning and no chance to manage it. After 3 good months, that avoidance starts to look less like discipline and more like excess caution. You look at an upcoming Coca-Cola earnings date and think, the last 8 trades worked, this company doesn't move much anyway, and you sell the put right into the report. Sometimes that works too, which is exactly the problem. Because a rule that gets broken and rewarded is a rule you'll break again, faster and with more size next time. Third, and this is the expensive one, you stop taking the small loss. The trade that used to get closed automatically at 5% against you now gets, in your own words, room to breathe. Winners don't panic, you tell yourself, and that phrase becomes the excuse. A trade that was designed to lose you $60 on a bad day is now allowed to lose you $300, because closing it early would mean admitting the streak might be over, and nobody wants to be the one who ends their own winning streak. 3 habits. All 3 feel like confidence. All 3 are risks you never actually priced in, sitting quietly on top of a strategy that used to be conservative. This isn't weakness, and it isn't a character flaw you need to feel bad about. It's wiring. Your brain remembers recent wins and weights them heavier than everything you learned before that streak started. That's recency bias, and it's not a niche behavioral finance term. It's the same mechanism that makes a gambler certain the next hand is due right after 3 good ones. Every winning trade also releases a small hit of dopamine, the same chemical response that makes slot machines and social media notifications work on you. Your brain doesn't distinguish between a good decision and a decision that happened to be followed by a reward. It just remembers the reward, and it starts nudging you toward whatever produced it, whether or not that thing was actually the cause. And your brain does something else during a streak, something almost nobody names directly. It starts writing you a story. 3 good months in a row doesn't feel like 3 independent coin flips that happen to land the same way. It feels like proof. This isn't luck, you tell yourself. This is skill. I finally understand how this works. Here's the uncomfortable part you need to sit with. A genuine skill-driven win streak and a purely lucky one feel completely identical while you're inside them. There's no internal sensation that tells you which kind you're in. The market doesn't send you a memo. It only tells you the difference afterward, usually with a bill attached. Let's put a number on that bill, because vague warnings don't change behavior, but math sometimes does. Say next month, writing that 3-month streak, you take a Johnson & Johnson put at 2 contracts instead of 1, because size crept up, and you let it run past your usual stop, because you're giving it room to breathe. The stock drops 15% on a guidance cut you didn't see coming. The position that used to cost you $300 on a bad month at the old size and the old discipline now costs you closer to $1,200 because you doubled the size and quadrupled how far you let it move against you before you acted. One trade, $1,200. That's more than your entire 3-month winning streak combined. 3 months of careful, boring, disciplined premium collection erased by one trade that only happened because the previous 3 months went well. That's the trap in its complete form. It isn't that winning makes you a worse trader. It's that winning changes your inputs without changing your process. And the process was the entire reason the first 3 months worked in the first place. So here's the fix, and I'm going to warn you now, it's boring on purpose, because boring is what survives contact with your own psychology later. Before your next winning streak starts, ideally today, while you're not currently hot and your judgment isn't compromised by a recent string of wins, write down 3 numbers. Not general principles, actual numbers specific to your account. Number 1, your max position size, stated as a hard number of contracts or a hard dollar amount, and it does not change after a winning month. Not usually 1 contract. 1 contract. If you want to increase size later, that's a separate decision made deliberately based on account growth and a real strategy review, not made silently in the middle of a streak because it felt fine at the time. Number 2, your max loss per trade, stated as a specific percentage or dollar figure, and it does not loosen after a winning month either. If your rule is close it at 5% against you, that rule applies identically whether you're up 14% for the quarter or down 4%. The trade doesn't know your account is having a good month. It shouldn't get special treatment because you are. Number 3, your max trades per week, or your max simultaneous open positions, whichever fits how you actually trade. And if you hit that number, you're done taking new positions, whether you're winning or losing that week. This one matters more than people expect because streak-driven overtrading rarely looks like recklessness from the inside. It looks like opportunity. There's always one more setup that looks good when you're hot. The trick behind all 3 of these isn't that they're clever. It's that you decide them when your brain is calm, boring, and unimpressed with itself. So you don't have to make the decision in the moment your brain is least equipped to make it well. Professionals in this business don't have more discipline than you do in the moment. Almost nobody does. What they actually have is fewer moments where discipline is required because they make the hard decisions in advance, wrote them down, and treated the written rule as non-negotiable regardless of how the last month went. One more piece worth naming directly, because it's the objection that usually shows up here. Cutting your size back after a good month, or refusing to bend a rule that's been working, doesn't feel like progress. It feels like leaving money on the table, like punishing yourself for doing well. It isn't. Sizing based on pre-commitment rules instead of recent emotion is not a punishment for winning. It's the thing that lets winning happen more than once. The traders who blow up rarely blow up during their worst month. Their worst month is usually small and controlled because fear keeps people careful. They blow up during or right after their best one because success is the only thing that convinces a disciplined person to stop being disciplined. So here's the actual mindset shift, and it's the one thing I want you to leave with. Your best month isn't proof that you've figured it out. Treat it as a stress test instead, one the market runs on you for free, handing you confidence and then watching quietly to see what you do with it. The traders who keep the money over years, not months, aren't the ones with the best win rate or the most aggressive sizing during hot streaks. They're the ones whose rules look identical whether the account is up 14% or down 4%. Same size, same stop, same weekly limit. That consistency, not the streak itself, is the actual edge. Thank you for watching all the way through. If this made the confidence trap click for you, a like on this video genuinely helps the channel, and subscribing means you won't miss the next one. And I'd genuinely like to know, down in the comments, what's the most you've ever given back after a winning streak? And did you see it coming before it happened, or only after? Happy trading!